All right, hi everyone, and good afternoon. Thank you for joining us today. Today, I will be your host along with Wilson, who is our wealth expert. We'll be covering the topic goals-based investing for families. So on the next slide, I just want to introduce Wilson quickly. He's a wealth expert at Syfe, and he specializes in investment and client management. So that means that he spends most of his time talking to clients and talking about how we can help them achieve their investment goals on Syfe. He was previously a banker with DBS, and he focuses on providing wealth management solutions. Yeah, and as you know, I'm responsible for investment research at Syfe, so that includes both content and also the investment products. And before joining Syfe, I was a product specialist with Franklin Templeton, Singapore and London. And before that, I was on the sell side doing research with Barclays in New York. Right. So at Syfe, we believe in giving you the tools and a platform that enables you to create a holistic wealth solution to meet your investment needs and goals. So on one hand, we have Syfe Wealth for a more hands-off approach to the managed portfolios, and then we have Syfe Trade for users who want to be more self-directed. Next, keeping your assets safe is our top priority here. One of the most common questions we get from customers is how are assets kept safe? So firstly, we are fully regulated and licensed by the MAS. Cash assets are kept in segregated accounts. So these are with DBS and HSBC. And then invested assets are held in custody with trusted partners like Saxo, Citi, and HSBC. This is important to note because if anything unforeseen happens with Syfe, you can be rest assured that your assets will not be touched. Just want to go over our agenda for today before we run a few polls. So we will start with what are some things to take note and take care of before you start investing, and then what is goals-based investing? What type of goals should I or my family have? So how to define the goals and how should you prioritize them? And then next, Wilson will cover, how do you use Syfe or some, different ways of investing to build your goals-based portfolio. And then lastly, we have Q&A. But actually, in the meantime, as we're going through the content, please feel free to send in any questions you may have as we're going along in the deck, and we'll try to answer them, as we're going over it, and also at the end if we can't cover them in time. Right, so we have three questions here. The first one is, have you started investing? Up to the yes or no, and whether you're currently a Syfe client. And the last one is, what are you currently invested in? So it could be stocks, it could be unit trusts, mutual funds, REITs, ETFs, bonds, and so on. Yeah, so for the second question, we've been asking this in our recent webinars just to get a sense of, how the split in audience, and also for us to decide, to make sure that the content, if it's something that most people are familiar with, we'll try to cover it more quickly. All right, yeah, thank you. Okay, so most people, about 85%, have started investing. And then for the second question, yeah, thanks everyone for answering this. So it seems like it's somewhat split, about 60-40. And in terms of what are you currently invested in, the most popular is stocks, followed by so REITs and mutual funds, unit trusts about the same, and ETFs about the same as well. Okay, great. Yeah, thank you. All right, so want to cover some essentials to note before you start investing. So before you start, it's important you take stock of some of these essentials. So this could include having an emergency fund. Generally, the rule of thumb is to have about 6 months worth of living expenses. Specific amount will depend on your lifestyle and your financial situation. So this should sit in a highly liquid and sort of like stable investment portfolio. So at Syfe, an example that we'd like to share is our Syfe Cash Plus. So it offers about 1.2% in return. It's been very stable. This sum of money should be very accessible to you at any point in time if you need it, for any unexpected spending that can be big without having to dip into your retirement funds, for example. And besides an emergency fund, we could also consider having insurance coverage, right? So for like life insurance and health insurance. In our opinion, and based on evidence, we think that investments and insurance should be kept separate. So rather than like through a combined product, like the investment-linked insurance product like ILP. So these are the basics before you start. And then if we can go to the next slide, in the next section, we'll talk a bit about how to define these goals that you would have. So here are some examples I think are very common goals that many people would have, right? So it could mean when you're sort of younger and we're just starting out, just have like bought a property or anything like that, then like renovation fund, like having enough money for the wedding or like that, and then moving on to if you have a child. And also investing for children's education is very important because we know that inflation has been quite high, about 5% in the latest reading, but generally it's about 2 to 3%. But for the inflation rate of just looking at like education, that has grown at a higher rate than the general inflation rate. And some of the nice to have, so like a vacation fund if you're thinking of taking a longer vacation, going somewhere further away for a long time, that's nice to have. And lastly, it would be retirement. I think the risk here, a lot of people are sort of, there've been surveys saying that people are more worried about like longevity risk, which is the possibility of them outliving the amount of funds that they have available to them, rather than death. Actually, like sort of. I think with life expectancy increasing, that it is a very important concern. Yeah, on the next slide, we have sort of a framework for defining and prioritizing your goals, right? So I think it's important to define your goals clearly, sort of like when do they start, right? How long will they last? How much will they cost? And then to divide them into different buckets, like if it's a short-term goal, a medium-term goal, and a longer-term goal. So paying for like a child's college education, if your child is maybe like 2 years old right now, so you have more time to achieve that goal. Versus like buying a home, making a down payment, that could be a nearer term goal, so like maybe medium term, 3 to 5 years, right? And then retirement, again, it's sort of a longer term goal. So you can think about like quantifying and really attaching more details to these goals by asking yourself these questions, right? So how much will each goal cost? And for the longer term goals, it becomes more important to account for inflation too. And the next question, sort of like, when do you need to achieve that goal? Is it in 2 years' time? Is it in 10 years' time? Is it 20 years' time? And currently, are you already walking towards that goal? If you already are saving and investing towards the goal, right? So how likely are you to meet that goal based on what you're doing now? And how do you increase your likelihood of meeting that goal in the future if you were to save more, if you were to save less, or invest a bit differently? And then lastly is, if you're already saving and investing, do you think you'll be able to, and you do DCA every month, would you be able to increase that contribution in the future, or will you be saving and investing less in the future, and how that affects the outcome? And then on the right, so prioritizing your goals, right? So you may not be able to sort of afford all your goals at the same time, and priorities can help to like determine how trade-offs can be made. So then deciding how much of your current assets and like future savings that you can put towards different goals. And if, for example, your child's education is a top priority, then would you be willing to consider like delaying retirement, for example, or spending less in retirement if it's needed, for certain trade-offs to be made. But generally, we think in terms of priorities, because from the perspective of most consumers, if you have debt, we think generally it's better to sort of pay off those debts, particularly if they come at a much higher interest rate, like credit card debt or consumer type debt. And then to have an emergency fund, and of course to have sufficient coverage, like the basic insurance coverage in place. And then the next goal, it's quite important, would be retirement, and then children's education, and sort of different subsequent goals, like paying off your mortgage and so on. Right, if we can go to the next slide. Yeah, this is a very general like budgeting rule. Like, if given that I think most people tend to be salaried employees, so every month where you get your salary, how do you sort of divide that sum of money into different portions? So we would say that generally for your wants, that includes things that that's very nice to have, like sort of luxury items that make you quite happy. That should be not more than 20% of your monthly take-home pay. And then the needs, just tend to make up the substantial amount of your total disposable income, so about 50%. And then lastly, for savings and investments, that would be the remainder. But assuming, of course, you do have like 6 months of monthly expenses set aside for emergency, and then you have the rest covered, and you can invest. You'll be able to invest the rest. Right. Yeah, I know most people have started investing from what we saw in the survey, but we want to mention that this will be an iterative process when your life circumstances change. For example, if you're relatively younger, and you don't have children yet, then if you're planning for a child or any subsequent children, or if one parent or if one spouse decides to sort of go for a new job and might be taking a pay cut or going like freelancing, for instance, right? So you want to have a framework in order to think about this and revisit where are you in your goals planning. So step one, like we covered, review your budget in the state of investments now. Are you holding too much cash in your bank accounts? I think in general, most of us do tend to hold more cash than what sort of like the general recommendation is. So in looking at some of the bank scams recently, people have left tremendous amounts of assets in their bank accounts and earning about 1%, while inflation is about 2% every year, and lately it's been very high, about 5%. So this means that spending power erodes over time. Step two, I think there's also for the big goals, they do tend to stay the same, but I think for like your number 3 and number 4 type goals, they can shift as your life circumstances change, right? And I think the best thing to do is to make the most out of time. Right? You want to have time on your side. So for your longer term goals, you can take more risk and weather market cycles. In general, like the more distant your goal is, the more risk you should be able to weather in order to meet that goal. So sort of like a nifty sort of equation, I can use the rule of 70. So that's a way to think about how long would it take for your assets to double. So for instance, if my rate of return every year, let's say the CPF account, it's like 2.5%, to sort of make it easier, let's say it's 2%, right? So it would take about 35 years for my assets to double. And then if I can take on more risk, right, in investing in equities, I think in general, for equities, the longer term like rate of return is about high single digits, right? So it will take fewer years, it will take about 10 years for me to double my assets. And then step 3, which tools can you use in order to reach your goal? There are many platforms like ours, but we are biased and we think that we are trying to build the best solutions for consumers in Asia. But you're free to explore platforms. I think the biggest advantage is that it offers a lot of transparency. You're able to know what you hold at any time. And then the ease of sort of investing, like deploying new funds and also withdrawing when you need to. And lastly, to automate the process, right? Because it is, you're supposed to sort of do this like over time, iteratively, and then to revisit, like to sort of do a gut check and see like where things are now. And we have seen a lot of evidence about how doing dollar cost averaging is the best way to do long-term investing. So we do have that ability to automate that monthly investment process. Yeah. So now going into the goals-based part of it, I think the biggest difference between like thinking of like more goals-based or versus like the more traditional approach. Just go to the next slide. So when many of us go to like a bank or a financial advisor, we're asked to fill in a risk tolerance questionnaire, and that determines the product offerings that we can buy. But that doesn't really provide information on whether I will be able to achieve my investment goal, right? This tells me that, okay, maybe I'm quite conservative, and so like this is the products I can buy, but whether this solution helps me meet my goal, I think it's still somewhat incomplete. Whereas goals-based investing, right, it helps you be more disciplined, and it gives you like a mental accounting framework to plan for your finances. So this approach draws on a behavioral finance concept where rules can influence behavior. So when people segregate their money into different accounts for sort of different mental accounts for different purposes, they are less likely to draw down on that sum for any unselected or unintended purpose. Right. So this would mean that, if you dip into those accounts for an unrelated expense, it's like violating a rule. So later on in the session, Wilson will run through some of these examples and case studies for you to understand, like, how do you set the rules and how do you sort of build your own portfolio that can help you to meet your investment goals. Yeah, and lastly, one last point for me is I think the most important thing here is that you want to make the most of time being on your side, right? And have an understanding of your family's contributions and future liabilities and how likely you are to reach those goals. So this goes beyond, like, earning a positive return, but rather, are you on track to meet your investment goals, right, for retirement? And this means, like, mitigating longevity risk, the possibility of outliving your savings. So in this chart, it's a simple kind of like cash flow or in terms of capital graph at different stages in life. So as you're when you're pre-family, before you have family, you're able to build up a lot of financial capital until you retire, and then you sort of draw that down over time, and then it splits into when you're in the active retirement stage, where you're sort of very healthy and you spend less on healthcare to further on, like, sort of the older you get, then it's more likely that you have to spend more on healthcare. So how do you also make sure that you have that path laid out? And yeah, I now hand it over to Wilson, who will go over how to use core satellite framework to build a goals-based portfolio for you and your family.
All right, thank you, Grace. Thank you for sharing on how the viewers can actually define goals and how goal-based investing is actually different from actually traditional investing. So for now, I'll be sharing more on how core satellite investing can actually help you achieve your goal. So before going into that, right, let me just give you a rough and brief introduction on the different roles of asset classes. So at Syfe, we actually believe that giving you guys the tools to actually enable holistic wealth solution. So over here, we actually lay out like 5 different kind of asset classes that's typically used in the investing world. So the most commonly used or known one will be definitely be cash, and cash is something that each and everyone is familiar with, and then it's in different forms, in the sense that it can be kept in a savings account, can be just kept in hard cash, or even like put it into a money market funds or even online wallet. But the main purpose for cash is usually to serve short-term expenses, and also to actually clear up debts or just put for emergency use. And whereas the next one we have is fixed income. So in terms of fixed income, we are looking at bonds, fixed deposit, endowment plans, debts. So this means that you are lending money to someone to get slightly higher returns as compared to putting it in a savings account, as compared to cash. And moving on to something that is more commonly used in the investment world also, it will be equity, something that a lot of people will be familiar with. So equity refers to like a stock, bonds, stocks, equity funds, ETF, or even investing to startup funding, or even index fund itself. So what it means is that by investing to equity, you're actually owning a piece of the business. So that's what it means by equity itself. Equity does have a higher risk, and therefore giving clients or even investors a higher return. So this is more for clients that want to accumulate and grow their wealth for certain goals that they have in mind. And next up, we have commodities and real estate. So these are more a form of investments or asset classes that some clients might use, such as older clients, they are more familiarized with gold, silver, or some clients are more into real estate investing. Therefore, these 2 buckets are something more unique and can be used as a form of diversification as well. All right, so moving on into core satellite investing. So for core satellite investing, there's a method that's a combination of active and also passive approach. So for the passive approach, right, you're actually looking to actually track the index and to lower costs and management fees as much as possible. So this is more for clients that have a long-term view and they want to maximize their returns by doing the list. So you will want to go for a passive approach. For active approach, this is more for clients that wants to outperform the market by choosing some investing into active funds that has a higher alpha, that can beat the index or beat the market itself. So this is for clients that have slightly more time on their hand and they want to actively manage their investments. That's what it means by an active approach. So you can see that over here, the portfolio design for a core satellite approach is combining the best of both worlds. For the core portfolios, the core satellite investment, the core portfolios actually represent the larger piece of the entire strategy itself. So you can see that for core satellite, it actually helps to reduce risk and also track the index. So for core satellite, in essence, it means to invest into a multi-asset portfolio that represent the core and is meant to hold long term to reduce the impact of market volatility. So this will be the main bulk of your investments, and rest for the satellite portion is actually the minority or the smaller portion of your entire investment portfolio. So this can be made out of individual stocks, individual teams, or even specific sectors that you have in mind. So this should be more short-term or even mid-term, but they are in a sense that they are higher in risk, therefore you're allocating lesser amount into them. All right, so in this slide, we'll be going through how can you create your core portfolio. So a rule of thumb over here is that the equity portion should be the percentage of the equity portion that should be in your portfolio. It should be using this formula, using 110 minus your age. So why is that so? Is that if you're younger, you have actually longer time, you have more time on your side. What happens is you're able to take up higher equity exposure, and this will give you or even generate a higher percentage of returns. And as you have different life stages and as you grow older, you will want to go on a more conservative approach and then de-risk yourself through owning more bonds or lower risk asset classes. So how can Syfe actually help you for your goal-based investing is that Syfe actually have multiple types of portfolios for clients to actually choose from. So an example over here is the different part of portfolios that we offer on our platform, ranging from core portfolios. Okay, so for our core portfolio, their risk-adjusted returns are maximized, and they consist of global equities, bonds, and gold itself. So we have 4 different portfolios for clients to choose from. And moving on for our REITs portfolio and thematic portfolio, this falls under our satellite investments. So for clients that are looking for more passive income approach or passive income portfolios, that's where they can actually look into our REITs Plus portfolio to generate the passive dividends from the REITs portfolio. And whereas for our thematic portfolio, these portfolios are more specific and concentrated into certain themes in the world now. So for example, we have our ESG and clean energy, the healthcare innovation, disruptive tech, China growth, or even global income. So typically for our thematic portfolio, this is for clients that have certain conviction in certain of the themes, and they will want to invest into them. So an example will be that for clients, for example, if they're working in the healthcare industry, right? So they will be more inclined to actually invest into a healthcare innovation portfolio because they understand how the industry works and they are familiarized with how the industry changes over time. So for them, they were more likely to be able to understand what they're investing into. Therefore, they will choose healthcare innovation. And moving on, we have our custom portfolio. So this is a custom portfolio for clients. They are more experienced and they have certain views or ETF that they want to choose and create their own portfolio. So our platform allows clients to actually customize their portfolio based on 100 over ETF that we have on our platform itself for them to actually build their own portfolio. And then for our Cash Plus over here, this is a cash management portfolio for clients to actually park their emergency funds or even some spare cash they have that is typically saved up in their savings account in the bank. So for our Cash Plus portfolio, it actually earns a projected return of 1.2%, and with no lockups, no limits, and meaning to say there's no fees charged to our Cash Plus portfolio as well. So clients can actually look to shift some of their funds over to their Cash Plus first before they actually intend to actually put into any of our core portfolios. So this is one of the strategy that some of our clients actually do make use of. And lastly, we have our new launch, which is our Syfe Trade. So this is Singapore's first new broker with money-free trades, fractional tradings, and also easy to use interface. So like I mentioned during my core satellite strategy, earlier on. So for our core satellite strategy, satellite can be used on our Syfe trade as well, meaning to say you can trade on our Syfe trade platform on individual stocks to construct your core satellite portfolio. Okay, so an example of the core satellite investment strategy can look like this. So the majority of it goes into the core portfolio, such as defensive, balance, growth, or even equity 100. The satellite can be in the form of trade, custom, the thematic portfolio, or even the REITs portfolio. So in this way, you do not have to use all the portfolios on our platform. You can just pick those that actually you have more conviction in, for example, the thematic ones, or you actually have a certain idea that you want to do it through the custom portfolios. So over here, we'll be going through one case study on Abby itself. So this lady, we call it Abby, and she has certain investment goals over here. So two of them, one will be saving 30,000 for a long family vacation. The second one will be to set aside 200K for a child's university. She actually indicated two different timeline, one 3 years, which is for a family vacation, and the second one 16 years for children's education. She has identified herself to be moderate risk and able to actually take up some form of risk, and she enjoy more hands-on in selecting her portfolio or in terms of exposure, like for example, using the custom portfolio to select the different ETF. All right, so this is a typical example that we have for clients, because as you can see, this is a common goal that a lot of working adults might have, or working moms. All right. So over here, we have our portfolio, our forecasting tool over here on our platform. And users can actually just go to our website to actually play around with it to understand and have a visual on how much they will actually receive, or through their investment, how much will they get if they invest with Syfe on the different portfolio. So over here, we have the first goal, family vacation, 30K in 3 years. The plan here is to invest $5,000 lump sum, $700 a month for 3 years. And since she actually identified that this is more short-term and she didn't want to take up additional risks and it's very short-term, she definitely want to go for something that's more conservative. Therefore, she actually chose a core defensive portfolio. All right, so the rationale here is that she's less aggressive and she has shorter time frame. She wants to seek stability for her investment to grow over 3 years. Next, for children's education, she planned to invest $500 a month for 16 years. And she have identified that she can use core growth portfolio, which is a diversified portfolio that invests into equity, bonds, and gold. And she wants to do a custom portfolio with Syfe Select and pick certain ETF that she believes that will craft or shape the future innovation. So some of the ETF that she can consider will be, for example, our new ETF that have launched exponential technologies, or even the cybersecurity technologies ETF that can help the different innovation in the world in the future. So the rationale here is that she's actually seeking for higher or greater return potential, and she still wants her diversification. Therefore, she have chose the core growth portfolio and the different thematic portfolios that I mentioned earlier. So another way to actually view it is to actually list down the different steps. So over here, you can see that for the first step is to actually identify the goals that she has. So for herself, Abby, she actually identified vacation funds, and the strategy is to choose what kind of portfolios that you want to use to reach this goal. Then the next one is to identify how much budget that you have. For example, if it's a lump sum of 5,000, and on a monthly basis, how much are you able to contribute after deducting, doing up your budgeting and deducting whatever expenses that you have, whatever that's left, that will be your investable amount. And also to know when is the end goal, or in other words, when do you want to cash out and use this fund, right? So by listing down this investment goal, strategy, and amount, you'll be able to actually see that your portfolio, in the sense that if you save it just purely by saving it, putting it in the bank, you only save 30,000, right? And it doesn't help you reach the goal that you need. Whereas if you invest it, you get additional 3,000 plus to actually help you fund your vacation goal. All right, so moving on to the next goal, similar method to actually map out your financial goal. So for this, the strategy that she chose is actually core growth and also Syfe Select custom. And she only willing to budget $500 a month for the next 16 years. So for that, if she do this purely by the traditional method of saving it into bank account or even into a fixed deposit, what happened is she will only get 96,000 as compared to if she invested, she will be receiving 230,000, which actually helped her achieve a goal of educational funds, which is 200K. Right, so we are moving on to the next case study. So this is David. So David has two investment goals. The first one is to save 800K for his second home down payment. And the next one, the second goal, is to actually have a retirement nest of 1.5 million. At the start, it might seem quite impossible to reach because of the large amount, but if you actually break it down, it will definitely be possible. All right, so he has actually set in, identified that the time horizon for both, one will be 5 years and another will be retirement for 15 years. And him himself being able to understand about investments, he actually identified to be a high risk taker, meaning to say he's willing to take higher risk to get that additional returns. Right. So for David himself, since he's aiming for retirement, he wants to add on an additional passive income during retirement. So he's looking to get $1,000 a month upon retirement. So putting this into consideration. So for the first goal that we have, all right, which is some property down payment, 800K in 5 years, right? So he identified that the spare cash that he can afford to invest is 600K and do a lump sum of $1,000. I mean, do $1,000 a month investment for the next 5 years. So for that, he used Syfe core balance as the main portfolio to generate this. Because he had a shorter time horizon, but he's willing to take higher risk. Therefore, he actually chose core balance to have higher allocation to the equity portion and meaning that he's willing to take a higher risk for that. So he's actually, he's also understanding that goal is important to him and he needs this, investments or this amount of money for his property down payment. Therefore, he do not wish to choose something that's too high in risk, just in case that, investments that is not guaranteed, it might not work with the way that he actually foresee. Therefore, in order to manage his risk and reward or risk and return, he actually chose a more balanced portfolio to help him. So next, we have our retirement funds. This is another goal that David have. So he wished to achieve 1.5 million in 15 years. So the plan here is actually to invest 3,500 per month for the next 15 years. And for that, since he know that he have a longer time horizon, he have chosen core growth. And on top of that, he wanted to receive $1,000 a month. He actually add on a REITs Plus portfolio to help him achieve his passive income dream. So for that, he have took a higher risk due to a longer time horizon and REITs for the passive income. So to put it into proper steps and to let everyone have an easier understanding of for David to actually have a clearer understanding and picture of how he can actually map out his investment goal, what he have over here is to write down what is his goals, strategy, and lump sum. So as you can see from this first roadmap, if you do it purely based on saving it, putting it into a bank savings account and just putting in $500 a month, he will only save up 660,000. As compared to investing it into a core balance portfolio, he will have received 930,000. So that's the difference here by setting out your goals and investing it based on your goals. Moving on to the second investment goal, his strategy for this will be for core growth and also REITs Plus portfolio because that fulfill his passive income needs in retirement. So for that, he indicated that he can only invest $3,500 a month, and for that he's willing to do it for 15 years. And if you do it just purely based on savings, what happened is that for savings he only received 630,000, and that will be far off from what he actually set out to achieve, which is 1.5 million. But by investing in it, he can actually receive 1.6 million, and also on top of that, from the REITs portfolio, he will receive 1.1K for the retirement. So on top of 1K that he actually set out, he actually can achieve more from his investments. So the idea here is to actually map out your investment goal by clearly stating the steps over here, like identifying your goals, your strategy, and budgeting how much you are able to invest at the on start and on a monthly basis. Once that's done, you will be able to actually stick to your goal, because that is the most important part in terms of investing for your goal. So on top of investing, right, Syfe, on our Syfe platform, you can actually automate a lot of things. And on top of that, we understand that having costs or having to do your own investments, there are additional fees such as admin fees, brokerage fee, and so on. On Syfe platform, we understand that fees or costs can actually eat away at your investments. Therefore, we want to keep things simple. So here's an example that if you pay no cost, meaning to say if there's no fees or no any additional charges to your investments, as compared to you paying 2%, how much you will lose and how much your investments return will be. So you can see that if it's no cost, you actually get an earning of 330,000. As compared to paying 2%, you will actually lose 170,000. So why are we sharing this is that on our platform, all right, our fees are low, and we are making sure that there's no additional fees charged upon our client. We don't charge additional trading fees, there's no exit or entry fee, and there's no minimum balance that you have to maintain on our platform. So on top of that, there's no lockup, meaning to say you can actually withdraw any point of time. And what we do on our end is actually we help you to do rebalancing and manage your portfolio for clients that are new to investing. So over here, this is our fee breakdown from basing on different tiers. So even if you start off with less than 20,000, the fees will be fixed at 0.65 per annum. There's no additional fees charged upon you. And as long as you continue to stick to your plans and your goals and invest accordingly, you'll eventually reach a next tier, for example, which is 20K or even 100K, and the fees will be lowered accordingly. So to end it off, if you guys are still unclear or are still confused about some of the stuff and you wish to seek guidance in terms of the different portfolios that we have on our platform, you can definitely reach out to us to review investments, to actually plan for the different goals that you have, or to understand what other options available for you at the current life stages. So at different life stages, definitely that you will have different options, but it's important to choose the one that makes the most sense and helps you reach your goal earlier or even quicker. Right, so this is a 6-month free waiver for any of our viewers over here. So once you actually start an account with us, you can use this promo code to actually enjoy 6-month free waiver for up to 50K. Maybe I'll just stop over here. Grace, do you have any questions for our clients or from our?
Yeah, actually, Wilson, do you mind going back to the previous slides? I want to mention that at Syfe, our advisors are not paid by commissions, right? Versus like what you might get when you go to a bank. And then also for ETFs, there are no trailer fees. For Cash Plus, there are trailer fees, but we do rebate them. So what this means that that essentially there's no conflict of interest, right? You'll be rest assured that the advisor will not be sort of like pushing you a product where they get paid to a commission to do it. So in that way, want to make sure that the interests are aligned as you're trying to navigate your investment journey. And we do have one question, but I'm not really sure because it's quite short. So I will maybe try to address this first, and then I have a few other questions that I have in mind. So someone asked about a 5-year plan. So BJ, if you want to clarify your question, but what I thought you meant is for someone who's investing for like a 5-year goal, a 5-year horizon, Wilson, how do you sort of talk a client through do that?
All right, I think great question here, right? So 5 years. So I think similar to what you have shared earlier, right? Rather, instead of just identifying the time horizon, it's also important to actually consider other aspects, right? Defining what kind of goals, right? What kind of priorities you have for this 5 years. Is it for big ticket item, or is it for children's education because you are starting off late? So it depends on what kind of goals we are actually talking about here. Therefore, you actually look at different kind of portfolios. So usually clients can actually schedule a call to actually speak to us, and from there we will be able to understand a little bit more on that, and then be able to advise further on how or even what kind of portfolio they can actually consider based on the goals that they have shared.
Okay, thank you. Yeah, maybe we can go to the promo code slide because someone asked if they can see it again, and I'll ask my next question. Yeah, given that you talk to many clients for, what are some, besides like retirement, which I think everyone is interested in, but given that people have different goals at different stages, or sort of they get activated at different times, right? So for instance, I'm saying for my child's education, they may not need it until they're maybe 18 or 20 years old. As that process is going on, right, how do you sort of align those goals to the outcome? So for instance, if I have multiple goals over different timelines, what's a good way that they can keep track of that? Would the clients sort of come to you every year just to check in on like how things are going, or what's the way to keep track of how the goals are performing?
Sure. So I think for this, right, for clients, right, they have multiple goals, because usually at one life stage, you might have multiple goals depending on the individual. So to fund for different goals, you have like different portfolios because of different timeline, different risk appetite, or different priorities. So for that, how do you keep track of it is definitely to do a review. So for clients that are investing with us, they can speak to us. We will be able to actually do a review of understanding whether does life stages have changed, or you can actually sit down to map out where are you at this moment. You can do a quarterly or even a half-yearly review to understand, are you on track? And if you're not on track, what are the possible way of doing things? Is it because of the market that's not performing, or is it because of some other reasons that you're not contributing for certain reasons, and therefore you're not on track of reaching your goal? So that's how clients can actually manage their investments. But more importantly is that that's why I mentioned earlier, once you actually identify the different goals, the keyword here is definitely consistency. So once you are staying consistent to your goal, you set out your budget, your monthly contribution, as much as possible, automate everything, and you do not really have to worry too much, because even if you are investing on Syfe platform, what happens is we are actually managing your portfolio in terms of investment prospect. There's not a need to worry. We will actually be taking care of it through multiple rebalancings throughout the year.
Okay, yeah, thank you. All right, let's see, we have okay, so we have a question from someone who says that with sort of the step one, right, when it comes to identifying the goals and objectives, what if they're also not certain of what these goals are like? Then if they need some help defining the goals, if you can go back to that slide.
Yeah,
would that be something that you can help with too?
Sure. I think I've actually answered this question quite a couple of times with some of my clients, right? So typically some people they can't really define their goals. So what I actually share with them is that it's all right to not be able to define their goals, because sometimes you haven't have a thought about it or have a specific goal that you want. So typically we classify this kind of thing as general investing, and you are in this stage of accumulation, because at the end of the day, when you invest for goals, you're also accumulating to a certain amount. So in this accumulation state, what you can do is, if you can't define it, your goals, the next best thing to do is actually define the timeline, right? So for example, you just want to invest for the next 5 years, because you know that by not investing, you're losing out, and by putting money in the bank, inflation will actually erode the value of it. So by defining like a time horizon, 5 years, 10 years, you're just doing a general investing and accumulating to X amount. That would actually be one goal that anyone can work towards to. Then after 5 years, that's where you know that I have X amount. Maybe I want to go for a short holiday. Maybe I want to buy myself like a branded bag, or treat myself to something good. So the goal doesn't have to be, if you do not have a specific goal, it doesn't have to be like the first step. The first step can also be a duration. So it doesn't have to be a hard and fast rule on starting on investment goal. It can be your duration first.
Okay, yeah, thank you, Wilson. Okay, we have one question about sort of the fees. Sorry, can you go back to the fees slide? So the question is, are the funds in Cash Plus counted towards the sum invested to determine the tier for management fees? And the answer is no, because Cash Plus, we don't charge a fee. Whenever we rebate any trailer fee, so effectively that's 0 fee, and also 100% trailer fee rebates, and it's projected for 1.2%. So because of that, that amount doesn't count towards the tier. So let's say if you have $80,000 in Cash Plus, but we don't really have any other investment portfolios, right? So the non-Cash Plus portfolios, then you'll be blue tier, even though you have 80% in Cash Plus. Hope that answers the question.
Maybe just add on this.
Yeah.
So for in terms of fees wise, if you're investing into Cash Plus, using Cash Plus first, then after that subsequently investing in other portfolios, you can have multiple portfolios. So for example, if you are having 80K in Cash Plus and then 20K in maybe a core growth portfolio. So what happens is you will be still tagged under the black tier. And on top of that, you can have multiple portfolio based on like a core satellite strategy. So for example, instead of just having one core growth portfolio, you can have 10K in REITs, 10K in core growth. It will still be a total amount of 20K, and you will be under black tier or 0.5% per annum.
Mm-hmm. Okay, thank you. Sorry, Wilson, could you go to the slide with the advisory team email? Because someone is asking if they have about $30,000 in disposable income and they would like to invest based on a short-term goal, how can they reach out to the team? So we do have the advisory team's email there if you want to reach out. And on the website, you can also do it through that. Okay. And we do have one question on, is there a calculator for us to calculate the estimated cash inflow from REITs and how we can invest lump sum? We don't have it on the website, but if you want to, you can definitely reach out to our advisors and we can help it out for you. Okay, and just the mark these. Okay, and lastly, is the fee charged to the entire sum invested or in terms of different brackets? If we can go back to so the short answer is it would be on the entire sum invested, right? So let's say you have, let's use the example of 80,000 in Cash Plus and then 20,000 in the investment portfolios, then maybe your black tier, right? And then so that sort of anything that's not Cash Plus that counts towards the pricing tier.
Yep. So if you guys have, in general, it just basically means that the amount that you guys are transferring into the investment portfolio, that will determine which tier you guys are in. So for example, if it's 20K, you'll be in black tier.
Okay. One last thing is, what is the difference between trading ETFs on Syfe Wealth versus Syfe Trade?
Okay, so basically in terms of Syfe Wealth and Syfe Trade itself, Syfe Wealth is more on the managed portion, meaning to say Syfe will manage the portfolio that we've chosen to invest in. And as compared to Syfe Trade, it's more on self-directed, meaning to say you pick and choose which are the ETF or even the stocks that you guys want to invest or want to trade in. So we do not actually manage those, and that's more self-directed. And that will fall under more active approach. So for clients that are new to investing, you can actually try that out. Or for clients that are more experienced investing, that's where you know exactly which ETF you guys want to trade in or which stocks that you guys want to trade. And you will tend to spend more time on the trade due to actively managing it, as compared to Syfe Wealth. It's more on automating the stuff and letting Syfe help you to manage it.
Yeah, if I could add, so if you do it on Syfe Wealth, right, you can build a portfolio based on, the different ETFs, and then you can also look at the composition and so on. So once you have that portfolio, you're able to do like DCA every month. And on Syfe Trade, something that we're working on, and you can also buy it on a recurring basis. But in that sense, you also be able to choose to whenever your portfolio drifts, means like the holdings move as the prices shift, then you're able to have the option to rebalance back to your target allocation when you started. So I think it's I think both ways it works depending on what solution you're looking for. Yeah, we do have one last question on the core portfolios. If you could to go back to that slide, Wilson. Yeah, so the difference between core equity 100 and core defensive. So the question is, for the core defensive, and people are saying they're invested in core defensive, and the returns year to date, and also longer term returns. why that seems to be a lot lower than if for like a growth or equity 100 portfolio.
All right, I think for good question over here, right? So for clients that are investing in core defensive, the primary goal here is actually for more on wealth preservation or something that you are investing for short term, right? So with that being said, the portfolio are constructed more weightage on the bonds portion. Therefore, you can see a lower risk and also low returns. As compared to like our core growth or even equity 100, you'll see that a higher allocation goes into the equity portion, which actually helps to generate a higher return. And therefore, this is for clients that have a longer time horizons or even higher risk appetite. So mainly the difference lies in terms of the asset allocations for each core portfolios.
Yeah, thanks, Wilson. Yeah, if I could just add, I mean, I think the basic difference there is the idea of risk premium, right? The fact that you're sort of being compensated as you take on risk, and for equities, you are taking on more risk, and hence your subsequently means that your expected returns should be higher to take on more risk versus like for defensive, you're being generally more conservative, and that also reflects in the returns. Okay, one more question. Sorry, this just came in. It's the difference between core growth and global income.
All right. So in terms of core growth, it's like the name suggests, right? It's actually constructed in the sense that help clients grow their portfolio or grow their wealth to X amount that they have in mind. For example, 5 years, 10 years, they want to grow towards 1 million. And global income, it's a thematic portfolio that we actually created to actually help clients to actually generate like the income on top of actually just investing to REITs that can actually generate passive income. The thematic portfolio can serve as a diversification to the different type of income alternative on the investment platform itself. So for global income portfolios or even the thematic portfolios that we offer on our platform, it's more on conviction-based or conviction investments, in the sense that, like I mentioned earlier, for clients that are inside the healthcare industry, they tend to invest more towards healthcare related investments, or for clients that are inside the ESG or even environmental industry, they will tend to swing towards ESG and clean energy, because they do understand how this industry will actually turn out in the next 5 or 10 years.
Yeah, thank you, Wilson. If I can just add that for global income, besides what Wilson mentioned, the sort of like constituents, like how the portfolio is built, is quite different too. So for global income, the target here is to get about 4 to 5% of income, over sort of measured annually. And then the base is that it's mostly bonds, but being very cognizant of like duration risk. So we're picking some of these like higher yielding bonds. So we have EM corporates, we have preferreds, we have high yield credit as well. So these, so the yields of these bonds tend to be higher, usually about 5% or higher. And then the proceeds from the coupon that these bonds pay, so it's income return, but also more recently we added REITs. So these are global REITs, like US plus non-US, and then all these like sort of income return would form the majority of that 45% projected return. And then also there's potential for capital appreciation, both from bonds, but more from REITs, because that tends to have both capital appreciation and income return.
All right.
Yeah. So yeah, thank you, everyone. Wilson, do you have any other remarks?
Yeah. Okay. So I think just to wrap things up, right? So especially for clients that are just starting out to invest, or for clients that are starting to get interested in investing, it's important to actually stay consistent towards the goals that you guys set out. So importantly, like I mentioned, it doesn't have to be start off with investment goal. You can start off with duration or in any manner. But more importantly, to actually write them down and be clear of what you're looking to achieve, what is the end goal that you want to achieve. And then having a comparison over here in the sense that you have the savings and investing, having to see the difference here will make you more inclined to stay committed to your investments. So this just sums up what I want to say. So for clients that wants to invest, stay consistent to your goal, and that will help you eventually to reach your goal eventually. Anything from our side, Grace?
I know that, that's it. Thank you, Wilson. Thank you, everyone, for for joining us today. Yeah, and please, if you do have any other questions, reach out directly to our advisory team, and you might get to talk to us too.
All right, thank you, everyone.